Welcome to the lecture on owner's equity. Just you may remember there's a formula that we had earlier in the course. Assets equals liabilities plus owner's equity. And we said that liabilities and owner's equity are the two claims on the assets. The company is like a briefcase, and all the assets in the briefcase belong to someone. They either belong to the creditors, that's liabilities, or they belong to the owners, that's owner's equity. And then I'll let you do the math yourself. We turn that formula into assets minus liabilities equals owner's equity. And we defined assets minus liabilities as being net assets. It means what of the assets are left after we were to pay off the creditors. And that is what the owners get. The owner's equity is what's left after we pay off the creditors. And we said that net assets is equal to common stock plus retained earnings. So that's a review of what we learned about owner's equity, that owner's equity is common stock and retained earnings. So before we get into this, we have to discuss a little about the various types of business organizations. Let's start with something called a C Corp, or a corporation. The reason it's called a C Corp is for the absolutely stupid reason that in the IRS code, this corporation is described in Section C, so therefore it's called a C Corporation. There's a different corporation, which we'll talk about a little later, that's described in Section S, and guess what's that called? An S Corporation. Okay, now, what is a C Corporation? It's corporation. What are the advantages of a C Corporation? Why do people incorporate? Well, the most important advantage is limited liability. What does limited liability mean? It means that if someone invests money in this corporation, the most they can lose is the amount they invested. Now, this is so important, it's just unbelievable. Let me explain why. Generally speaking, if you're listening to this lecture, you're probably not wealthy, because if you were wealthy, why would you waste your time listening to this lecture? However, since you're listening to this lecture, you're in college, that means you're brighter than the average person. You probably have 120 or higher IQ, and maybe you're even blessed with some creativity. Well, that means you may come up with a great idea. And we've already learned that a great idea without any money is worthless. So what you're going to have to do is raise capital. You'll have to go to people who have money. You have the idea, they have the money, and you're going to have to talk them into giving you money. And they'll give you money, and you promise them, yes, you don't promise, but you paint this whole picture of the wonders that you will create and all the money you'll create, and they'll get money and you'll get money. Now, so you're talking to someone and you're going in and you're saying you're asking, let's say, for $5 million. That's always the first step in any business to start it, is to raise the financing. From cash flow, that's the financing section of raising the capital. So you're talking to this person who invests $5 million. Let's say the person is worth $500 million. Well, then he starts thinking. He says, sounds like a good idea. If I give him the $5 million, I may lose it. And he's sort of figuring things out. If I lose $5 million, it'll hurt. Okay, I'll get a tax write-off, that. Okay, it's not going to affect my living standard if I have $495 million instead of $500 million. So that sounds like okay, he can live with the risk, and you're describing these wonderful returns to him. And then imagine if in the middle of your discussion you say, there's a very low chance, but there is a chance that if the business goes bad, you will lose every penny you have. Well, what's he going to do? What's he or she going to do? They're just going to take you and throw you out the window, because they are not going to take their whole wealth and have it risked based on you In other words, they're willing to give you $1 million, they're willing to give you $5 million, but they're not willing to risk everything they have on your idea. So the corporate form is what allows them to give you $5 million or $1 million or whatever they give you, knowing that they will never ever lose more than that. Because the minute there's a possibility that they'll lose everything because of your business, they don't want to talk to you. They're not going to listen to you. So the corporate form is critical in a capitalist society to be able to get a partnership between people with ideas and very little capital, that they should get married to people with a lot of capital and not such great ideas. And together they'll do well. And the idea of a corporation is a very, very ancient concept. I've done some work on it that appears in Rome. They already have corporations. And in fact, I even wrote an article that in the Bible, there's actually the idea of limited liability also. So this is a very, very ancient idea, and it's critical to the whole corporate system and to whole wealth creation, is the idea that a rich person can invest in a business, but he can't lose more than his investment. Now, there's another advantage to a C Corp, which is that transferring ownership. If you have a public company, a public corporation, and you want to sell your shares, you just go to any one of these brokers, and on the internet you can sell it in 5 seconds. As we'll see in other business forms, the transfer of ownership is much messier, much difficult, very hard. But I want to point out that that is just what's called an institutional factor. That means it happens to be that in America, that the stock market basically sells shares of corporations. They could just as easily sell shares in partnerships, but they don't. But there's no real logical reason for it. It could be tied to the idea that corporations can raise capital. So if I want to buy the shares and you're selling the shares, I know that I can only lose the amount that I pay for the shares. So maybe that's why it's so easy to transfer ownership, because I don't have to really check what the risk is. I know I'm not risking anything more than the capital that I'm giving. So this is so important, I'm just going to repeat it, that the two amazing advantages of a corporation are limited liability, which allows you to raise capital, and the transfer of ownership for a public company is really very, very automated and a very simple system. Now, there are some disadvantages to a corporation. One is double taxation, that when the company makes money, they have to pay taxes, and when they pay out the dividends, then the person who gets the dividends has to pay taxes again. Of course, if the entity getting the dividends is, let's say, a pension fund, well, they're tax-free. And it's much more complicated than I made it with double taxation, because there are all sorts of other deductions and things. So, but the basic idea is that there are two taxes. There's taxes once on the income for the C Corp, and when they pay out a dividend, the person that gets dividend has to pay taxes on it. And there's more paperwork when you start a corporation, which again is institutional, and nowadays you can get people to do it for very, very little money. You don't need a lawyer. You can have one of these online firms that do a very good job, and they do all the paperwork, and it's all automated for you, and you can set up a corporation. So that is a C corporation, and that's very, very important. And when people say corporation, they mean the C corporation. Now let's look at some of the other forms of organization. There's something called a partnership or a single proprietorship, which for us are almost the same thing. A single proprietorship means there is one owner, and a partnership means there is more than one owner. That's the only difference between the two of them. And it's really simple to form. You don't even have to file paperwork. You just open up your shingle and say, that's it. I have a business. I have a store. One of the big disadvantages of partnership and single proprietorship is unlimited liability. Now, for someone who's starting a store and doesn't have any money, unlimited liability doesn't really mean anything, because if you got nothing to lose, because if they sue you, well, you just declare bankruptcy and they take the store. So the whole idea of limited liability is only important when you have someone who has assets outside the business. But a person all their assets are in the business, it doesn't matter. They lose the business, they lose everything, and they can't lose more than the business because they don't have more than the business. It's a very important legal principle. In other words, legally, if you win a judgment against someone for $10 million and they have 43 cents, well, you're going to collect 43 cents on the $10 million and you'll never see a penny of the other $10 million. The rest of it's just lost. So for people, that's why a partnership, or a single proprietorship especially, is a very useful form of business for people who are just starting a business and don't have any capital other than the business. Now, there's something called the Subchapter S Corporation, which is a corporation, but, so therefore it has limited liability, but it's taxed as if, it's not taxed directly, it's just taxed like a partnership or single proprietorship, where the tax is only paid to the owner. Let me discuss that in a minute. It's called a flow-through idea. If you set up a partnership, the partnership does not pay any taxes whatsoever. It's totally tax-free. However, all the income is allocated to the partners, and the partners pay taxes on it. That's why the partnership and a single proprietorship, there is no double taxation. It's single taxation. All income is taxed to the owners. Well, in the Subchapter S, it's the same idea. All the income of the Subchapter S flows right through to the owners, and it's taxed to the owners once. And there are many detailed rules that keep changing on how many shareholders you can have in the Subchapter S. Subchapter S is also popular in the tax code because now certain conditions, Subchapter S pays less than regular corporation. So the rules change, and there's much more complexity than I'm willing to go into. But I do want to get the basic ideas. And so if we look at the three things we've learned so far, C Corp is unlimited liability but double taxation. A partnership is single taxation, unlimited liability. And the Subchapter S has the best of both worlds in that it is a single taxation and it has limited liability. Now, more recently, there have been LLCs and LLPs, which are limited liability companies and limited liability partnerships, which, as they sound, they're not corporations, they're just a company or a partnership, but they do have limited liability. These are more recent creations. The difference between the LLC and the LLP, whether to form that or to form a Subchapter S, has to do with the tax rates. What are the actual tax rates? And this is far, far more complicated than this course. In other words, you have to take a course in taxation and not just in personal taxation, but in corporate taxation, to really understand this and make an intelligent decision. What you really do is, when you're starting a business, you hire an accountant and you ask them what is the best thing to do, and they'll ask you a whole bunch of questions and they'll help you out with this. Now, there's something called a limited partnership, which is interesting, that some of the partners are general partners or some are limited partners. So there are limited partners and there's a general partner. Now you might ask, wait a second, why would anyone want to be the general partner if they could just set up that everyone's a limited partner in a limited liability partnership? I'll give you an example. You'll see that it's a little more complicated than we're learning here. Let's say we're doing a real estate deal, and one person is going to be making all the business decisions, and he's raising money from people, but he doesn't want them involved in the management. He wants to do the whole management himself. Now, in a limited liability company, since all partners are equal, well, they usually have some management say, and it can get a little sticky there. In a limited partnership, he can be the general partner, and all the other people putting in money are limited partners. Now, they want to be limited partners because they do not want the idea of unlimited liability. So they're happy with a limited partnership, but the rule is that they are not allowed to do any management. If they do any managing, then they lose their limited liability and they become unlimited liable. So that means that these partners will never ever bother you, they'll never ever try and manage the business because they want their limited liability. So therefore the general partner can do all the management. So in other words, what I'm trying to get across is that there's more factors here than we're covering, but since this is an accounting course, it's just an introductory accounting course, I just want you to see the basic principles and the basic ideas between these corporate forms. You're not really ready to make an intelligent decision on what to do based on this lecture. It's sort of like if you heard a lecture on brain surgery, it doesn't mean you're ready to take a knife and start cutting open someone's brain and start fooling around with it. You really have to study it a little more than the level we're doing it, but the lecture will still cover the basics of brain surgery, and we're not doing brain surgery, we're just doing organizations of business. This covers the basics of the organization. Now, pass-through, the number of pass-through businesses. Pass-through businesses means that there's only one taxation, not double taxation. If you notice the number of businesses, there are a huge amount of sole proprietorships, a couple of partnerships, a couple of S corporations, and notice S corporations has started getting more, and it's more than partnerships and more, and C corporations, very few C corporations, and basically it's all sole proprietorships. So if you look at the number of businesses in the United States from 1980 to 2011, by far sole proprietorship are the most common. On the other hand, if you look at the amount of total payroll C corporation is more than everyone else combined. And in fact, sole proprietorship is the smallest. So what does that tell you when you look at these two charts? When you look at these two bar charts where you say, yes, there are just very few C corporations, but they are huge. Every major company that you can name, whether it's IBM or whether it's Google or whether it's Exxon or whether it's Amazon, they are all C corporations. So there are very few in number. There are a lot of sole proprietorships, but they're all tiny. All those sole proprietorships pay very, very, very little wages and salaries. There are very few C corporations. They pay huge amounts of salaries. So a lot of small sole proprietorships, very few huge corporations. That's what America looks like. Okay, so since C corporations are the largest, and they make up the largest part of American business, we're going to focus just on C corporation and the accounting for C corporation. And in this course, we don't even cover how to account for partnerships or anything like that. We just focus on C corps. Now, in the stock, there are three important terms used in stock: the number of shares authorized, the number of shares issued, and the number of shares outstanding. The number of shares authorized means the shares that the company is legally allowed to sell. If they did sell, if they didn't sell, it doesn't matter. It's the amount they're legally allowed to sell. Issued means the number of shares that are actually sold. And a company can buy back their own shares. When they buy back their own shares, that's called treasury stock. So the amount of shares outstanding are the shares held by investors, which excludes the treasury stock. So what we get is that if you take the number of shares issued and you subtract the treasury stock, that gives you the number of outstanding shares. Now, it's important to understand which the book may not even mention, that the number of shares authorized is a useless number. The reason it's a useless number is because if we have 1 million shares authorized and for some reason we want to sell more, well, the board of directors gets together, votes, and says, okay, should we change the authorized shares from 1 million to 2 million? Someone goes, motion that we can issue 2 million shares, and someone else said seconded, and everyone goes, all ayes, everyone says aye, yes, passed unanimously. Now they're authorized to sell 2 million shares. So there's no issue in authorized shares. It's maybe years ago, 150, 200 years ago, this was a meaningful number, but now this is an absolute garbage number. Now when I say a number is garbage, I mean something very specifically. I mean that how much would you pay to get this information if you were analyzing the company? And if the answer is you wouldn't pay much for it because it's pretty much, then it's garbage. Or another criterion would be, does Warren Buffett look at the number of authorized shares when he decides whether to invest in a company? And the answer is no. So that makes it a garbage number. Now, stocks have something called a par value or a stated value. The par or stated value. Now, it is very important to know, and the book doesn't stress this enough, that the par value is a garbage number. When we sell the shares, when the company sells the shares, they sell the shares at market value. And the market value is a real number that the stock sells for. And at this point, I have to give you my theorems that I developed. It's called the garbage theorem. Let's build up the garbage theorem. Let's give me an example of a garbage number. You have a Social Security number. That is a garbage number. The reason I call it a garbage number is because you can't add it, subtract it, you can't do anything. Yes, it's a number and it's made up of numerals, or think about your 8-digit ID that CUNY gives you. That's also a number, but we can't do any math with those numbers. You can't add the numbers, you can't subtract the numbers. It's not meaningful. So it's an identifier that happens to be a number. On the other hand, if you have $5 in your pocket, that is a real number. If you have half of that, you'll have $2.50. If you have twice that, you'll have $10. If you lose $1, you'll have $4. In other words, that's a real number because we can use mathematics on it. This is a garbage number, the Social Security number, because you can't do mathematics on it. Now, what happens when a garbage number meets a real number? Well, what happens if I have a garbage number and a real number? Think about that. If I take my Social Security number and I add 5 to it, what do I get? Garbage. Okay. What happens if I have a garbage number minus a real number? I take my Social Security number and I subtract $5 from it. What do I get? Garbage number. What happens if I take a garbage number and multiply it by a real number? I take my Social Security number and I multiply it by 5. What do I get? Garbage. What happens if I have a garbage number and I divide by a real number? What do I get? Garbage. From which I develop the garbage theorem, which is garbage dominates. Whenever you have any garbage number, that will dominate everything that's happening. Now, what is the practical usage of the garbage theorem? Or why is it so important? Well, I discovered the garbage theorem many years ago, but here is a Dilbert cartoon. The pointy-headed boss is clueless. He doesn't know anything. He says, use the CRS database to size the market. So Dilbert tells him, that's a dumb idea because the data there is all wrong. When he says the data is wrong, what would you call that? You'd say, the data is garbage. Ah, okay. So the pointy-headed boss says, well, then use the SIBS database. So Dilbert tells him that data is also garbage. So the boss, who's not that well versed in math, says, can you average the CRS database and the SIBS database? And Dilbert says, sure, I can average it. I can also multiply them. And what is he saying by that? He's saying, yes, if I average two garbage numbers, what do I get? Garbage. I may as well multiply them and get garbage. What's the difference? It's garbage, it's garbage, it's garbage, because garbage dominates. Now, let's get back to our problem of issuing common stock. Let's say we sell 1,000 shares for $30 a share. So that brings us in 30,000. But the par value is a penny each. So that means the par value of the 1,000 shares are $10. And we've already learned that the par value is garbage. The penny par value is garbage. And the $30 that we sell it for, that's a real number. Okay, so we make the entry. We say, okay, we debit cash $30,000. $30 times 1,000. And we credit common stock at the par value. We credit common stock at the par value. And you notice that doesn't balance. So what are we missing? We're missing a credit of $29,990. Now the 30,000, is that a real number? Yes, that's a real number. The common stock, is that a real number? No, that's the par value. That's total garbage. It means nothing. When I say it's total garbage, I mean that if someone is buying or selling shares, anyone who's listening to this lecture, if you're selling shares, do you know the par value of the shares that you're buying or selling? Probably not, because it's total garbage. Well, if 30,000 is a real number and $10 is a garbage number, then the difference is a garbage number. So therefore, what are we going to do with it? Well, what do you think we do with garbage numbers? We put it in the garbage can, right? That's what we do with garbage numbers. But we have to give a name to the garbage can. So we give a name to the garbage can, and what we call it is APIC, Additional Paid in Capital. And that's the entry that we make. We debit cash 30,000, we credit common stock 10, and we credit garbage can APIC. Now, whenever you see the word APIC, what I want you to think is not additional paid in capital. I want you to think garbage can. And it appears in the owner's equity section. So the owner's equity section will say common stock plus additional paid in capital plus retained earnings is equal to total owner's equity. So we have now learned that common stock is actually broken up into two accounts, the common stock garbage and the APIC garbage. Both these numbers are absolute garbage. If I actually add it together, I know how much we sold the common stock for. But as we'll see, APIC is a garbage can, so there's a lot of different garbage that goes in the garbage can, just like in your garbage can at home. And that's really all there is to say about common stock until we get to treasury stock. Now let's go to preferred stock. Preferred stock, it's like first class, like you fly in an airplane, there's where you and I sit, and then there are first class passengers. When food is being distributed, they get first. When someone has to go to the bathroom, they have their bathroom. You're not allowed to go there because you're not in those seats. They get first in everything. Well, same thing with preferred stock. Preferred stock is like first class. When there are dividends, they get the first right to the dividends. And their dividends is a percentage of their par value. So in preferred stock, the par value is very important. It is not garbage because it is used to calculate their dividend. And they have the first right to distribution if a company dies. Usually they don't have voting rights. About 20% of the largest U.S. companies have preferred stock outstanding. And here's a table that you can see by yourself. Voting rights is usually only common stock. Risk, common stock has the highest risk because if the company dies, they get paid last. Bonds have the lowest, they get paid first, then preferred stock, and then common stock. The expected return, common stock has the highest because when the company is doing better, the common stock will do well, the preferred stock will go up a little, the bonds don't get anything from that gain. Dividends, bonds get interest first, and then preferred stock, and then common stock. And when the company dies, then first bonds get paid, then preferred stock, then common stock. And what we spoke about tax deductibility of payments. Common stock and preferred stock dividends are not tax deductible to the company, but interest is. And interest is, but that just changed in the new tax law that they limited the interest, which we spoke about in an earlier lecture. Okay, so these are the preferred stock. And things are a little more complicated because they're also convertible, redeemable, and cumulative stock. A convertible preferred stock means that the shares can be exchanged anytime for common stock. For instance, let's say it might say that these preferred stock are convertible into 5 shares of common stock. That means whenever you want, you can give the company your preferred shares, and you have 100 shares, they will give you 500 common stock. So that's a feature that you have sometimes in preferred stock, that it's convertible. There's also something redeemable, which is shares can be returned to the corporation at a fixed price. Whenever you want, you can redeem your preferred stock at a certain price. That's less common than convertible stock. And the most important preferred stock, most important feature is cumulative. The rule is, and we'll see that a little in the next slide, that preferred stock gets dividends first. Now, and if they don't get theirs first, then common can get nothing. So common only gets after preferred gets their stock, gets their dividend. This is sort of like if there's not enough food in the airplane, well, then the first class passengers will get fed, and if there's nothing left, then the common shareholders, the people sitting in economy class, will not get any lunch, they will not get any drinks, they will not get anything. Only after all the first class passengers have been served, if there's anything left, then we give it to the common people. So same thing with dividends. Preferred stock gets the first dividend. After they get their dividend, then the common can get a dividend. Now, what happens if in 1 year preferred doesn't get dividends? Do we say, well, they didn't get dividends that year is gone, so now next year I just have to pay them their dividend before I give the common? Or do we say, no, it's cumulative. If you didn't pay me last year, you have to pay me the second year before you pay common. So in cumulative stock, what we do is shares receive a priority, not just for future dividends, all dividends that are not paid in a given year accumulates. Let's see how this works. I think the example makes it much clearer than the definition. Let's say if the specified dividend is not paid in a given year, the unpaid dividends, which are called dividends in arrears, accumulate, and the firm has to pay them in later years before we can pay any dividends on the common stock. So assume a company issues 1,000 shares of 8% $30 par value stock, and 1,000 shares of $1 par value common stock at the beginning of 2013. Remember, the dollar par value common stock is an irrelevant number. It's pure garbage. Now, if the preferred stock is cumulative, then each year the company owes a dividend on the preferred stock of $2,400. Why? Because you've got 1,000 shares, 30 par value at 8%, you work it out, it's $2,400. Now let's say that the dividend is not paid in 2013 and it's not paid in 2014. That means there are 2 years we didn't pay that dividend. 2 times 2,400, there's $484,800 of dividends in arrears. And let's say the company pays a total dividend of $10,000 in 2015. How much would the preferred get in the common share? Well, if the preferred is cumulative, we say, you owe the dividend arrears, $4,800 for 2013, 2014, and you're paying preferred dividends this year, you got to pay that, so that's $24. That leaves $2,800 left over for the common shareholder. And that's how we'd allocate the $10,000 dividend. If the preferred stock is non-cumulative, we say, well, 2013, 2014, that's gone. In 2015, we owe you $2,400, so now we can give the $7,600 to common shareholders. That means you're always better off having preferred stock that is cumulative than having preferred stock that's non-cumulative, because the cumulative stock is safer, because the company can't pull this game of not paying dividends for a couple of years and then 1 year just throwing them that $2,400. Every year that they don't pay dividends, it accumulates. Now let's talk a little about treasury stock. Treasury stock is when a company buys back its own stock. That means if Google buys Amazon stock, that is not treasury stock. That is an investment that Google is making in Amazon. If Google buys Google stock, that is treasury stock. If Amazon buys Amazon stock, that is treasury stock. It's a company buying its own stock. If a company buys someone else's stock, they just debit investment and credit cash. But what happens if they buy their own stock? Now, about 2/3 of publicly traded companies show that they have treasury stock, which means this is not uncommon. Why on earth would a company spend good money to buy treasury stock when they could just issue the new stock and not pay anything for it? Why do companies repurchase their stock? Well, here are a couple of reasons. One is if they think the stock is underpriced, then if they think the price is too low, they buy the stock from the market. And if you remember economics, 5-minute university, supply and demand, that decreases the supply of the stock in the market. And when supply goes down, price goes up. 5-minute university, supply and demand. When Johnson & Johnson announced the plan to buy 5 billion of its outstanding shares, from the announcement, the stock jumped 3% because people said, supply of stock is going to go down. Price went up. The other reason they want to do it, if they want to reward their shareholders. So let's say they have extra cash. They could pay it as a dividend, but if they pay it as a dividend, then the people who get it have to pay taxes on it as a dividend, whatever that tax rate is. But if they buy back the shares and the share price goes up, people can sell the shares and then they only have to pay tax on as a capital gain. So there's a tax advantage to giving back this money by having the price of the shares go up rather than paying it as a dividend. Again, you're not responsible for the details of this, just the concepts. Also, there's something called earnings per share. Earnings per share is net income divided by the number of shares. Now, if we repurchase the shares, that reduces the number of shares, so our earnings per share goes up. And the fourth thing is you have stock employee ownership plans where the employees get stocks. And so Microsoft, for instance, repurchased shares of its common stock because they issued shares to their employees and they wanted to keep the number of shares constant. So these are business reasons why companies do buy back their own stock and why there's treasury stock and why it's so common. And now let's do the boring part of this, which is the journal entries. What are the journal entries for buying treasury stock? Now we're going to just do one method. There are actually two methods. We're going to record the treasury stock and the cost of the shares acquired. So assume we have a company that repurchases 100 shares of its own 1 penny par value stock at $30 per share. The $1 par value, that's a garbage number, ignore it. Okay, they're paying $30 per share, so they credit cash $3,000, assets going down, and they debit treasury stock $3,000. Now, where is treasury stock? It's not an asset because these are our own shares. It's shown in the owner's equity section. We have the preferred stock and the common stock and the additional paid-in capital, retained earnings minus the treasury stock. The treasury stock is a debit. When you put a debit into owner's equity, it reduces owner's equity. So this is a reduction in stockholders' equity. So if someone asks you what kind of stock is treasury stock, the answer is treasury stock is a contra equity account, which is a new idea. Up to now, we've only had contra specific accounts. So we had a contra receivable account, allowance for bad debt. We had a contra equipment account called accumulated depreciation. This contra account is not contra a specific account, but it's rather contra the whole equity section. It's subtracted from owner's equity because it reduces owner's equity. Notice that this entry is the mirror image of selling common stock. When we sell common stock, we debit cash and credit common stock. When we buy it back, we credit cash and debit treasury stock, which is put there on the bottom of the whole owner's equity section. So that's the entry when we buy treasury stock. It's pretty simple. It's just whatever you pay for it, that's the entry. Now, what's the entry when you sell treasury stock? So let's say we have this treasury stock that we bought for $3,000. We now sell it for $3,500. You say, oh, okay, I can make that entry. Cash went up by $3,500, so we debit cash. And we got rid of all the treasury stock. The treasury stock is a debit, so to get rid of it, how do accountants get rid of things? We credit treasury stock, and that's it. Wonderful. Debit cash, $3,500, and credit treasury stock, $3,000. The people that are all awake when they're listening to this lecture say, wait a second, Professor Davis, you can't do that. The entry doesn't balance. Okay, so good. Let's credit it $500. That's it. Yeah, I know. Oh, you want a name for that also. Okay, you want a name for that account. Good. Okay, you want a name for the account. Now, let me ask you, what should this be? If I sold something for $3,000, I'm sorry, I bought it for $3,000 and now I'm selling it for $3,500. What do we call that when we buy something? The sacrifice value of the treasury stock is $3,000. The benefit value is $3,500. There's a difference. That should be a gain. So you would say we have a gain on selling the treasury stock. However, it's somehow incestuous that we have a gain selling treasury stock because we are this company and we are owned by the shareholders, and we obviously made this gain from our own shareholders because they're the ones who bought it from us and sold it from us and sold it and bought it for us. So there is a rule that the SEC has which says, thou shalt have no gains or losses when fooling around with thy own stock. Now I have a serious problem. It's a gain because we bought it for $3,000, we sold it for $3,500, but we're not allowed to call it a gain, so we can't call it a gain. Because if we do, the SEC will break our fingers, so we can't call it a gain. So what are we going to do? We have a credit, which is a gain, but we can't call it a gain. Well, guess what? We have our garbage can called APIC, and that's what we credit. We credit the APIC for $500. So the entry becomes debit cash, $3,500, credit treasury stock, $3,000, and credit not gain, credit garbage can, APIC for $500. Okay, that's if we sell it at a gain. What happens if we sell the treasury stock at a loss? So let's say we sell this treasury stock for $2,500 instead of for $3,500. Well, again, we develop the entry, debit cash, $2,500, credit the treasury stock, the book value of the treasury stock, which is a debit. So to get rid of it, we credit $3,000, and it doesn't balance. So we debit $500. You say, what do we have here? We have a loss. But no. no, we can't, no gains or losses when fooling around with our own stock. So we're going to put it into the garbage can. So we'll debit APIC for 500. Now, APIC is a funny garbage can. It's a garbage can that you can put in as much credits as you want, but you can't go into debit. That's like overdosing. So, what happens if, let's say I have no APICs, I can't debit APIC. Or if I only have 200 of APIC, I can only debit 200 APIC, and I got to think, what do I do with the rest of it? So what do I do if I have a debit and I can't debit APIC? Notice a credit I can always credit. It's a funny garbage can. Put as much credits in as you want, but you can't overdose on debits. Well, the answer is, on the balance sheet, there's an alternate garbage disposal unit. Besides APIC, it's called retained earnings. So if there's no more APIC, we go to our alternate garbage disposal unit, otherwise known as retained earnings. And that's really all there is on treasury stock. Okay, now let's talk a little more seriously about dividends. Dividends. Legally, you have to have retained earnings to declare dividends. You can't pay dividends unless you have retained earnings. But that's not very useful because you can't pay out retained earnings. Retained earnings are just a number. Practically, you must have cash to pay dividends, because when you pay dividends, you're paying out cash. And what is the relationship of cash to retained earnings? There is none. So a company can have a huge amount of retained earnings, but if they don't have cash, they cannot pay a dividend. If they go borrow money, well, then they can go pay a dividend because now they have the cash. So legally, all you have to have is retained earnings, but practically you have to have cash. And practically it has to make sense for the business to declare dividends that they can afford to give out the cash. And now we get to an important principle. There is no legal obligation to pay dividends. Let me repeat that. A company never, ever legally has to pay dividends. Shareholders cannot go sue the company and say, hey, they got all this extra cash, we want them to pay dividends. Company does not have to pay dividends. There's no legal obligation to pay dividends. If they want, the company can pay a dividend, but they're not legally obligated. Notice the difference between this and bonds. In bonds, the company must pay the interest. If they don't pay the interest, they will get sued and driven into bankruptcy court. But if they don't pay dividends, no problems, because there's no legal obligation to pay dividends. So now, why is it, if there's no legal obligation to pay dividends, why do some companies pay dividends and some companies don't pay dividends? Or why don't some companies pay dividends at all? Well, obviously, if they're unprofitable, they don't have cash. They don't have cash. They can't pay cash dividends. Okay, that's obvious. But why is it that profitable companies, really big profitable companies, choose not to pay cash dividends? Well, companies go through something, a growth phase, where they're growing and growing. They have expansion plans. Growth companies need cash to grow. So they say, look, if we have cash, we're going to reinvest our earnings in growth. We're not going to give it out as cash dividends. Starbucks is a nice example. For a long time, they take the cash and they keep building more Starbucks stores, more Starbucks stores, more Starbucks stores. And they say it's pretty dumb for us to go pay out the cash as dividends because we can use the cash much better than you can. But as companies mature, and their growth opportunities diminish, they start paying dividends. For instance, Microsoft, you may have heard of that company, right? They make Excel, they make Word, they make PowerPoint. And Walmart, you may have heard of that company, they sell a lot of stuff. They never paid dividends in their early growth years. They said, hey, we have cash, we use it for growing. but they began paying them in more recent years because they reached a mature stage. So the short answer to this is as follows. Companies in growth stages, growth companies, will not pay dividends. And mature companies, since they don't have anything great to do with their cash, will pay out dividends. The question is, why would any investor buy stock in a company like Starbucks if they don't receive dividends? And dividends, right, that's how we get the profit that they make. So, but they announced they're not going to pay dividends for the next 10 years. They're not going to pay dividends for the foreseeable future. Why would you buy shares in a company like a growth company? The answer is because share price increase. If the stock price appreciates, if it goes up, you can sell the shares and make a profit on it. So people invest in growth stock not because they want the dividends, but because it's a growth stock, so they hope the price will go up, and the price of the stock goes up, they can sell the shares and have a profit. Now, let's talk a little about dividends. In dividends, there are 3 important days. One important day is the declaration day. The declaration date is the date that the board of directors declares a dividend to be paid. It's at that point that there's a binding legal obligation to pay the dividend. When the board of directors votes that we're going to pay dividend, there was no legal obligation to pay the dividend, but once they take that vote, now there is a legal obligation to pay the dividend. So we have to make an entry to record that. So we create the liability. Liability goes up $500 called dividends payable, and we debit dividends. It's $500. That's the amount of the dividend. Okay? So it's debit dividends, credit dividends payable. Better debit, credit dividends payable, the liability first, and the debit to dividends. Now, dividends is a temporary account that is closed into retained earnings at the end of each year. Remember, we had this. What gets closed into retained earnings? All revenue accounts are temporary accounts closed into retained earnings. All expense accounts are temporary accounts closed into retained earnings. And dividends is a temporary account closed into retained earnings. Okay, so at the declaration date, we record the liability and take it out of dividends, out of retained earnings. Debit dividends, credit dividends payable. Now, which day? Who gets the dividend? The shares are being traded every day. So when on the declaration date, the board of directors also sets something called the record date. So let's say the record date is April 1st, and it says whoever owns these shares on April 1st gets a dividend. That means if you buy it on March 29th, you will get the dividend. If you buy it on April 2nd, you will not get the dividend because you're not going to be the holder of record. The holder of record on April 1st will be whoever you bought it from. So when you buy the shares on April 2nd, it's called trading ex-dividend. Even though the dividend hasn't been paid, when you're buying it after April 1st, you will not get the dividend. Now, on the record date, there is no entry because nothing happened. It's just then we look at the computer database, we see who the owners on April 1st, and they're the ones that get the dividend. Now, let's say the payment date is April 15th. The payment date is also set by the board of directors. So on April 15th, when you pay it, what's the entry? Well, it's a very simple entry. It's just paying off any liability. How do you pay off a liability? You credit cash, because that's how we pay it. We don't pay with chickens or anything else. And you debit the liability, dividends payable. So on declaration date is when we create the liability. On record date, we do nothing. And on the payment date, we pay off the liability, so we make an entry. Now, what's interesting about it is, when will the stock market react? Well, the main reaction is going to be the day of the record date, because remember, I'm selling you the shares April 1st, you get it April 2nd, you're not getting a dividend. So let's say it's a large dividend, well, the price should drop by the amount of dividend, right? Whereas April 1st, the shares should be worth more. As someone who buys it April 1st is getting it with the dividend, and April 2nd, the price is going to drop because that's without a dividend. So the major stock price drop is going to be on a large dividend, is going to be on the record date. So it's sort of interesting that the day that something happens in the stock market is the day we make no entry. The days that we do make entries, not much is going to happen in the stock market, especially on the payment date. Nothing's going to happen because that's nothing to do with stocks here. There might be a signal, but the main event that happens in the stock market is when we make no entries. Now, there's something called stock dividends and stock splits. Basically, in a stock dividend, instead of sending you cash, they send you more shares. In a stock split, they give you more shares. In a stock dividend, let's say 100% stock dividend would mean that if you own 100 shares, they send you another 100 shares. In a stock split, it would mean that you give them your old 100 shares and they send you back 200 shares. So right now, there's really no difference between the stock dividend and the stock split. In both of them, you had 100 shares before we started, and you have 200 shares after the stock dividend or stock split. Now, when you get a stock dividend or stock split, does that really mean anything? Well, imagine that you have pizza. Let's imagine that the company is like a big pizza pie, and you own 25% of the company. So if the pie is split into 4 pieces, then how many slices do you have? You have 1 slice, okay? Now, but imagine if I slice the pie into 8 slices. I say, hey, look, before that you had 1 slice. Now you have 2 slices. Don't you feel great? And you sort of look at me and say, not really, I don't feel that great. All you did was cut my big slice into 2 little slices. I have the same proportion of the pie that I had before. So going from 1 slice, which is 1/4 of the pie, to 2 slices, each one 1/8 of a pie, what has changed? Do you have more pizza? No, you don't. So what does a stock dividend and a stock split do? It doesn't change your percentage of ownership. So what are you getting? Which then raises the question, why would anyone in their right mind do a stock dividend or a stock split? And the answer is to get the price in a desired range. In other words, let's say shares are trading now at $1,500. And you say, $1,500, that's sort of too much. A lot of people want to buy 100 shares. They can't buy shares that are selling for $1,500. So let's get the price down to $500. So then we do a 3-for-1 stock split or a stock dividend type idea, and we give you 3 shares for 1, and the price will drop from $1,500 to $500. So the firm can set the price in a desired range by using a stock dividend or a stock split. Now, when governments do this, what is it called when the government keeps issuing more slices? This is called inflation. In other words, in inflation, the government gives out more money, and governments like in Venezuela or something are giving out a huge amount of money. So you have a huge amount of money, but you can't buy anything with the money because the currency is worthless because it's being inflated so much. So company has to be careful when they're doing this. Companies are careful because they wanted to get a certain price. Governments are not that careful, and they're governments that let their currencies go wild, and they have runaway inflation, and they keep issuing more shares. They say, hey, you got more dollars, you got more Venezuelan pesos, you have more whatever it was in the African country that had inflation. You're talking about inflation of $10,000 a week. And of course, you had it in Germany in 1923, after World War I, before World War II. You had this runaway inflation where stamps went. I had a stamp collection from that. Went from, like 25 pfennig, like was pennies, and then it went up to marks, which was like dollars, 10 marks, 100 marks, 100,000. You start having stamps of 1 million and 5 billion marks for just a dumb little postage stamp. And sometimes you'd have a stamp that was nicely engraved at 100 million and it was stamped over 5 billion. Because by the time they were ready to sell it, 100 million was less than a penny. So when the government does these type of stock dividends and stock splits with the currency, it is called inflation. Now let's focus on the difference between a stock split and a stock dividend. In a 2-for-1 stock split, you give me your 100 shares, you get 200 new ones. In a 100% stock dividend, you have 100 shares and you get another 100 shares. Those of you that are good at math sort of look at this and say, what is the difference? Well, in a stock split, I end up with 200 shares. And in a stock dividend, I end up with 200 shares. So the answer is there is no difference between a stock split and a stock accountant. A stock split and a stock dividend. Okay. Now let's do the accounting. In a stock split, the par value of each share is adjusted. So let's say the par value is 10 cents a share, and we do a 10-for-1 split. So now we give you, instead of having 1 share with 10-cent par value, you have 10 shares with 1 penny par value. The total par value does not change. So there is no entry for a stock split. Nothing has changed. All that's changed, it's like walking into the store with $1 and walking out with 4 quarters. That's what a stock split is. You gave me the $1 and I gave you 4 quarters. You end up with the same amount of money. Yes, you now have 4 shares instead of 1, but each share is 1/4 of the par value. Each share is going to be 1/4 of the market value. Nothing happened, no entry. The stock price will fall to 1/4 what it was, but that's it. Now, what about in a stock dividend? Well, in a stock dividend, let's first talk about a large stock dividend, which is 25% or more. In a large stock dividend, the price is going to adjust, we assume. But we issued new shares, so the shares are just issued at par value. So we issue common stock of $10, 1,000 shares at a penny par value, and we debit dividends. It's called stock dividends instead of cash dividends, but it's treated as if it's a cash dividend. Notice the entry is done all at par value. So any large stock dividend, 25% or more, all we do is issue credit common stock and debit at retained earnings. We debit dividends, which goes into retained earnings. So we're transferring $10 from retained earnings into common stock. In a small stock dividend, which is defined as 10% or less, in that case, we say, well, the market might not notice it. So the entry is made at market value. The debit to retained earnings, the dividends, is the market value of $30 a share, or $3,000. And we're issuing common stock of par value $1. You say that doesn't balance. Oh, where are we going to put that thing that doesn't balance? You got a number at market value, 3,000. We have par value $1, and what doesn't balance, we put in the additional paid-in capital, which is the garbage can. So here again, we're assuming there's no material impact on the share price. That's why we can use market value. Here we assume the prices will change, so we do not use market value. Now, this is really where it's as if we issued it for cash. Imagine we issued the $30 a share, 100 shares, So we would get $3,000 cash and credit common stock for $1 and APIC $2.99, and then we paid a cash dividend to our shareholders. So we would credit cash $3,000, pay dividends, put these two entries together, erase the cash, and that is the entry. Now you might ask, wait a second, if a large stock dividend is 25% or more, a small stock dividend is 10% or less, what do I do between 10% and 25%? And the answer is you flip a coin. No. The answer is you use your professional judgment to decide which one it is. Now, so summarizing what we have till now, in a stock split, there's never an entry. In a large stock dividend, the entry is made at par value, debiting dividends, crediting common stock. And in a small stock dividend, we debit the dividends for market value, credit common stock at par value, and throw the difference in the garbage can. Now, look at something important. This, which is the most complicated entry, what happens to assets and what happens to liabilities? Nothing. What happens to assets and liabilities here? Nothing. What happens to assets and liabilities here? Nothing. In all these entries, what happens to assets and liabilities? Nothing. What do we know about par value? It's a garbage number. What am I doing in all these entries? All I am doing is moving the garbage. Well, retained earnings and common stock and APIC. All these numbers are really garbage numbers. It has no effect on assets, no effect on liabilities. So stock splits, large stock dividend, small stock dividend, yes, the accounting for it is different, but in terms of the investors, in terms of what the market is interested in, there's no difference between stock splits and stock dividends. That finishes the first part of our lecture on Chapter 10. There is a quiz, but there's no homework. There's going to be a second part to Chapter 10 dealing with the price-earnings ratio and the earnings per share, and then we'll have a quiz on that, and we'll have homework on all of Chapter 10. Thank you.